What the Four Corners program suggested was not that you were evading tax at all, that would have been libelous, but that you were minimising tax.
There's nothing wrong with minimising tax. I don't know anybody who doesn't minimise their tax.
And that you were doing so in ways that were contrary to the spirit of the law.
Well, I just got through telling you what I thought about that. And what you're saying is exactly what the Four Corners program says. I am not evading tax in any way, shape or form. Now, of course I am minimising my tax, and if anybody in this country doesn't minimise their tax, they want their heads rent. Because as a government, I can tell you, you're not spending it that well that we should be donating extra.
That was Kerry Packer, once Australia's richest man, and media tycoon's famous blast against tax in 1991. The video was from a 1991 Senate inquiry into print media that delved into the tax affairs of Mr. Packer's publishing company, Australian Consolidated Press. After a prolonged legal fight, Mr. Packer won a court battle with the tax office in 1998 to cut his 3-year income tax bill from $40 million to $0. In the 21-22 financial year, the total taxation revenue was $683 billion. It had grown 15% compared to the previous year, which takes up about 30% of GDP. If we break it down, individuals' income tax contributed the most, representing 39% of the revenue, and company tax takes about 23%, which includes the income tax paid by superannuation funds. We may not have the luxury that mega rich people have, such as choosing a country with a lower tax rate as their tax residency, but there are still ways to minimize our tax with the limited tools that we have. So what are they? First of all, let's talk about the personal income tax domain. We all get to pay personal income tax at our marginal tax rates based on our income tiers plus 2% Medicare levy. And this tax amount was taken off by our employers before we had any chance to see them. Of course, any realized capital gains needs to be added to the taxable income. And then you have the company tax, which companies either pay 25% if they are base rate entities or pay full company tax of 30% if they are not eligible. And with the comparison of personal income tax, companies only get to pay taxes based on their final net income after deducting business expenses with a relatively lower tax rate. And then we got the superannuation, which is a type of trust. And any superannuation guarantee and salary sacrifice contributed to super funds are taxed at 15% concessional tax rate, which ATO set an annual cap of $27,500 per year. If we think of these different structures as our vehicles to help us save tax bills, most people are liable for the personal income tax. If you're a business owner, you can take advantage of the lower company tax rate as well as get your business expenses to write off before paying the company tax. Of course, we can all make concessional contributions to our super funds to the limit of $27,500 per year. I don't know if you have heard of the federal government is seeking to introduce an additional new tax of 15% on the earnings from individual super balances above $3 million.
And today I'm announcing that earnings on super balances above $3 million will have a concessional rate of 30% rather than 15%.
Under the calculation formula, unrealized earnings would then be taxed, and this will be a radical change in the tax system because tax is currently only applied to income received and capital gains realized. And super is already not an attractive early retirement planning tool for people in the FI community, but if this proposal is passed and applied for the 2026 financial year, I think it would discourage and make more people rethink if superannuation is still an effective tax entity to plan for a normal retirement. And we'll see what happens. But for now, what are some strategies for us to minimize taxes? Number 1, family trust. For those having a family business or wanting to invest a substantial amount of assets, setting up a family trust can be a great way to distribute income generated from the business or investments to a family member with a lower tax rate. Unlike superannuation, which is locked away until retirement age, family trust assets are available to family at any time, and it can also provide a layer of asset protection from any legal disputes to family members. Before setting up the family trust, that you need to consider things like, do you have substantial assets that you need to put into it? Or the tax saved in this structure needs to be exceeded the cost of setting up and running the trust to make it worthwhile. Tip number 2, structure investment properly. If you're not setting up a family trust in the short term, we must carefully structure investment ownership properly before buying the assets. So try to make the lower income earner as the owner of any investment assets because whoever owns these assets and receive the income pays the tax, including capital gains. If you happen to put the investment under the high income earner, it's very difficult and expensive to reverse it because shifting between family members usually triggers capital gain tax or stamp duty or both. Tip number 3, buy shares with Franken Credits. When a public company pays taxes on its profits, it can allocate some of those taxes to shareholders by attaching Franken Credits to dividends. And this is done to prevent double taxation, one at the company level and then again at the personal income level. Let's say company A pays a 30% tax on its profits. If it then pays a shareholder a dividend of 70 cents out of that dollar, the shareholder will also receive a Franken credit of 30 cents. And this credit represents the tax that company A has already paid. So if the shareholder's marginal tax rate is below that 30%, they may get a refund equal to the difference between their marginal tax rate and the company tax rate. On the other hand, if the shareholder's marginal tax rate is above 30%, they will only need to pay taxes on their dividend at their marginal tax rate minus 30% on a tax return. Tip number 4, negatively gearing. Say you own an investment property, the expenses of renting out the property typically include mortgage interest, ongoing costs, including repairs and maintenance, and council rates, water rates, strata fees if it's an apartment, and insurance, just to name a few. It's quite possible for the total amount of expenses to be greater than the rent that you're receiving. That means the property is negatively geared or you are making a loss on the property. In Australia, you can use this loss to offset your taxable income, reducing your tax bill. On top of that, you may be able to subtract the depreciation from the taxable income if it's a newly built property. This way, you can sometimes turn a negatively geared investment into a positive cash flow after accounting for the tax return. Tip number 5, debt recycling. Another tax-effective strategy that people seldom talk about is debt recycling. And debt recycling is a strategy where you try to turn your home loan into a tax-deductible investment loan. As a home loan doesn't make you income, any expenses attached to it are not tax-deductible. And what you do is you pay down your mortgage and reborrow that money to invest. And now the reborrow money is tax deductible as it was investing into income generating assets. We're not doing debt recycling, but I've seen one of the YouTubers in Brisbane doing it. And one warning, if you are willing to take this strategy as its more risky approach, because you are leveraging to invest and borrowing money for investing in rising markets can lead to significant gains, but the reverse holds for falling markets. And your losses are magnified as you still have to pay interest and repay your loan. Maintaining a high savings rate is still the key to building wealth, whether you use this strategy or not. Tip number 6, delay income. Another way to reduce tax is to delay your income for the current financial year. If you have a business, consider postponing your invoicing after 30th of June, or if you would like to realize some capital gains from investment, sell it during a lower income year. For example, if you know that you will be taking maternity leave or change your work from full-time to part-time. But either or, it's better to hold the assets more than 12 months before selling to get a 50% discount on the capital gains. Now, let's move on to another structure, superannuation, which should be everybody's secret weapon regarding saving tax. During the accumulation phase, any concessional contribution is taxed at a flat rate of 15%. So is any income generated by the super balance, and capital gains within super are taxed at 10% if assets are held for over 12 months. When you enter the pension phase, your super fund's investment income and capital gain tax rate falls to 0 if your total super balance is less than 1.7 million. And for this particular reason, you may consider even setting up a self-managed super fund to be able to buy other type of assets such as property. I made a video before talking about the pros and cons of setting up a self-managed super fund. I put a link down below if you would like to check it out after watching this one. So number 1, you can make concessional contribution. Any pre-tax contribution, including super guarantee and salary sacrifice, up to 27,500 are taxed at 15% for most Australians. And this increases to 30% for those earning 250,000 or above. Unused cap amounts can be carried forward for up to 5 years before they expire as long as your total super balance is below 500,000 prior to 30th of June. On the other hand, I think the non-concessional contribution deserves more attention than it gets. Yes, the contribution has already been taxed, which is normally higher than 15%, But the earnings on the investment are taxed at 15%, still much lower than if you hold it outside of super. And more money in super means more potential capital gains are tax-free when you enter the pension phase. And everyone gets an after-tax contribution of $110,000 each financial year. You can also take advantage of the 3-year bring forward rule, which involves prepaying 3 years worth of non-concessional contributions of $330,000, allowing for even greater savings on taxed earnings. Now, I want to spend some time talking about the capital gain tax within super. Capital gains within super are taxed 10% if assets are held for over 12 months. Why 10%? If assets are held for over 12 months within super, only 2/3 of the capital gain is taxed times 15%, therefore 10%. And this tax typically occurs when you move to another super fund or switch from your current investment options. However, different super funds treat this matter differently. The vast majority of industry super funds apply this tax at a fund level, which means that it's worked out prior to allocating individual net gains and losses to member accounts. Therefore, it is already reflected in your unit price. In contrast, many retail funds apply this tax at an individual level. So when you are thinking of switching super funds, it's worth to call them up to confirm whether they apply to the fund level or individual level. Tip number 8, get private health insurance. If you don't carry private hospital insurance but are single and make more than $93,000 a year, or you are family and make more than $186,000 per year, you will pay a minimum 1% Medicare levy surcharge. And this is collected on top of a mandatory 2% Medicare levy that most taxpayers must pay anyway. And this additional levy can be avoided if you have hospital insurance with an excess of no greater than $750 for singles and $1,500 for families. And based on your circumstances, if the private insurance premium costs less than the levy, you certainly should get it. Even if it's slightly more expensive, you would want additional healthcare benefits through private health insurance. Tip number 9, use a tax accountant. Not only a tax accountant can save you time and hassle to do the tax return, did you know the accounting fees are tax deductible as well? It's even worthwhile if you have both personal and company tax returns to do. Alright, I hope you get some tax saving tips that you never heard of before. Do you know any other tricks to minimize tax legally? Feel free to leave a comment and let us know. My name's Irene. I'll see you next week. Bye.